Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we are tackling the persistent volatility gripping US markets as investors navigate a complex web of trade tensions, economic signals, and shifting sector performance. I'm your host, and over the next few minutes, we'll break down what's driving the turbulence, who's winning and losing, and what it means for the broader economic outlook. The first half of 2025 has been marked by heightened uncertainty, much of it stemming from aggressive new US tariffs and the threat of retaliatory measures from major trading partners. President Trump's administration announced sweeping tariffs earlier this year, pushing the effective rate to the mid-20% range, much higher than Wall Street had anticipated. Right, this aggressive stance fueled fears of a global trade war, sending shockwaves through equity and bond markets. Right, but it isn't just trade policy rattling investors. Ongoing geopolitical risks, ranging from Middle East flare-ups to regional conflicts in Asia, have added to the sense of unease. The result? Markets are on edge with each new headline prompting swift reactions across asset classes. The impact on equities has been clear. Both the S&P 500 and Nasdaq have seen modest declines in recent sessions, reflecting investor caution. Meanwhile, the CBO Volatility Index, or VIX, often called the market's fear gauge, has climbed, signaling elevated anxiety about the near-term outlook. In fact, the spring of 2025 saw VIX movements in the 99th percentile of historical changes, rivaling volatility spikes seen during the financial crisis and the onset of the COVID-19 pandemic. In this uncertain climate, sector rotation has come into focus. Utilities, known for their stability and reliable dividends, have outperformed as investors seek safety. Utility stocks are up sharply year to date, benefiting from their defensive characteristics and steady cash flows. Right, this outperformance is reminiscent of past periods when utilities provided a stabilizing force during economic downturns. Turning to the labor market, the data has been mixed. While the overall unemployment rate remains historically low at 4.2%, initial jobless claims have crept higher, with the 4-week average reaching its highest level since August 2023. This uptick in claims suggests some softening in the job market, likely reflecting the challenging environment created by higher tariffs and business uncertainty. Although employers are still adding jobs, the pace has slowed, and layoffs are becoming more frequent, particularly in sectors sensitive to global trade and interest rates. Right. On the fixed income side, bond markets are reflecting expectations of gradual monetary normalization. Treasury yields have been on the rise, with the 10-year note recently ending at 4.38% and the 2-year at 3.90%. Right. This has resulted in a steepening yield curve, a classic sign that investors expect higher inflation and possibly stronger growth ahead, despite the near-term risks. Credit spreads have widened slightly, indicating increased caution, right? But fundamentals remain relatively sound. Right? So what does all this mean for investors and the broader economy? The persistent volatility is likely to continue as markets digest the evolving trade landscape, geopolitical headlines, and mixed economic data. Defensive sectors like utilities and financials may remain in favor, while interest-sensitive and growth-oriented stocks could face further headwinds. For policymakers, the challenge is clear: balancing the need to support growth with the imperative to keep inflation in check, all while managing the fallout from trade disputes. Right? As always, staying diversified and focused on long-term fundamentals remains the best strategy in turbulent times. And that wraps up today's episode. Thanks for joining me as we navigate the twists and turns of today's markets. In the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.